Welcome everyone to today's webinar. My name is Ryan. I'm with the Business Journal, and today we have two awesome guests from the law offices Johnson & Johnson, Attorney Nils P. Johnson Jr. and Attorney Karen Bavard. They have an excellent presentation for us today to kind of warm us up on what we can expect to be coming from Congress. There's a lot of pending legislation that could affect high net worth individuals and business owners, and the team at Johnson & Johnson has some actionable plans that you can take now to make sure it's not as much of an impact on you. So without further ado, I'm going to turn it over to Nils.
Good morning, everybody. We are a 101-year-old firm. This is our 101st year. Johnson & Johnson was started by my grandfather, Walter Johnson, and my father, Nils Johnson, was in the firm. And he had three sons who were attorneys, and I've got three children who are attorneys, and my son, Nils Peter, and daughter Molly Johnson are in our office here. I have another daughter and a lawyer in Boston. And then Attorney Karen Bavard to my right, and Attorney Jason Vergraca. We handle business law. We do a lot of estate planning and probate. We also are actively involved with real estate, and included under that category, we do a fair amount of oil and gas work. And then other people in the firm handle trial and appellate work. But thanks for joining us. We are concerned because working with our business clients that the, let me get back, there we are, that there are some real challenges coming down the road right now by the Biden administration and by several of the other proposals that are in Congress, both on the Senate side and the House of Representatives. They are potentially devastating for business owners who haven't planned and who are not liquid and who do not have the wherewithal in the circumstances of a unplanned death to come up with the money to pay the tax within 9 months after somebody passes on. So let me start our presentation here.
So I'm sure a lot of you have seen that there have been quite a few articles popping up about the president's proposals and some of the other ones. Some of these really are very significant, as Nils said. There's also those pending legislative initiatives that correspond to the president's plan. We cannot cover all of these items, but we're going to really focus on some of the things that have to do with the estate planning. But for business owners, there are just a ton of proposals out there that really need to be dealt with. And of course, we don't know yet which or if any of these proposals are going to be enacted, but I think it will probably behoove you to start talking to your attorneys, accountants, financial advisors, life insurance about, whether these changes are going to impact you and what steps you might need to take. And normally when a bill becomes law, there's a future effective date. And I think a lot of times people figure they don't need to do anything. They can wait for that future effective date. But as you're going to hear today, some of these proposals may be effective on enactment, and some might be retroactive if they pass as proposed. So
it does seem, though, Karen, that we do have a short window of opportunity here to take some significant steps that are going to benefit business owners.
I think that's right, and I think the more you know about it, the more you can look to see if any of these steps are right for you and what you might need to do. So let me talk about the president's American Families Plan. So the American Families Plan, I think back one, there you go. So the American Families Plan is basically the, in the Green Book, the so-called Green Book. The Green Book is just a general explanation of what the Treasury proposals are. And these are the Treasury proposals for fiscal year 2022, and the proposals to raise revenue. So when you hear this, remember, this is geared toward raising money for the administration to do some of what they have in mind. And you can see that they've got an income tax. They're going to move that back to a 39.6% maximum rate. It's currently 37. This is going to apply to income earners where they make more than $400,000 for married filing jointly. It's proposed about $509,000. And for trust and estates, remember, they've got the compressed rates, and you're still going to hit that highest rate at about $13,000. So there's some things that you really should look at right now just because of the income tax proposal.
We'll
Go ahead.
cover some of these later on in the presentation, but just to kind of mark them up in front of you initially, some of the things you're going to want to think about doing are taking losses that you might otherwise take in 2021 in 2022. You're going to want to, in all likelihood, hold substantial deductions until the following year. We'll talk about this as well. On the estate tax side, those of you who have very substantial estates may want to actually make some gifts this year to be taxed at the current 40% rate under the Sanders plan, one of the ones we'll talk about. Rates could go as high as 65%. So there's a lot of things to think about. And finally, I'll just mention Roth conversions might be something you want to think about taking, paying some tax by withdrawing money from a 401k or an IRA right now in 2021, paying the tax at the lower income tax rates and converting to a Roth and allowing that money to continue to grow tax free. You have to model that. You got to, with your accountant, or get out your Excel spreadsheet and actually do some heavy lifting and figure it out. But that may well be a beneficial move.
Well,
Let's talk about the capital gains rate.
Yeah, sure. So the capital gains tax, the proposal right now, it's 20% for high earners. And there's a little Medicare kicker, the 3.8% for the net investment tax. That is going to, the capital gains, the top rate is going to increase to ordinary income tax rates, 39.6%,
Exactly.
plus that kicker for investment. And that means that your high income earner, if you've got income of over $1 million, now all of a sudden you're going to be paying regular income tax rates on capital gains. There's no benefit there. This, I guess, is the Warren Buffett thing, because he says that he pays a lower income tax rate than his secretary, and apparently now they're going to make sure that he doesn't.
That of course is because of all the deductions he gets and the
well, and he also pays, it's also capital gains, so he's paying the 20% rate,
right,
as opposed to the 39. So that's where they've got this. Please note that this is proposed to be retroactive to the announcement date. So when they issued the Green Book in April, they said that they want this to be effective back to then. So in terms of your gains tax.
Don't you suppose that the Biden administration was worried about people, if they didn't make it on effective on the time it was proposed in April, that everybody and his brother in December would be selling and to realize their gains in 2021, and it might have caused some instability in the stock market. That's my take.
Well, I think that may very well be true, but I just think that one of the things is that for people who are looking to sell, I mean, because we just said in terms of keeping your income tax low, where some of that is effective, now all of a sudden they're going to catch on the capital gains rate.
But do note, emphasize it again, that this applies to gains in excess of $1 million. So we're going to talk about how we have to use that in our planning.
That's right. And I think for business owners, I mean, really, one of the things you have to look at is whether that's going to affect, when you're looking at capital gains, how is that going to affect if you are thinking of selling your business?
Exactly. If you're selling a business in 2021, you really have to pay attention to what's happening in Washington. If these rates do go up, and they're going to go up, we just don't know the level. And you're selling a business, surely you're going to want to think about an installment sale. Under the installment sale rules, income is taxed when it is received. So if you're selling over a 5-year period, receiving payments over the 5-year period, that would be better to keep your, say you're selling a $5 million business. You're going to want to take your gains over 5 years, each one of which will have less than $1 million of income associated with that particular year. On the other hand, if you have a business that's selling for less than $1 million, of course, you may want to elect out of it, even if it's an installment sale. Maybe you're selling your business going to be paid over 3 years. You may want to take the income if it's under $1 million. And elect out of the installment sale treatment. Again, you've got to work the numbers.
Yeah, and see where it does because of the lower income tax rate. And one of the more dramatic proposals that is in the American Families Plan and in some other plans as well is the repeal of the stepped-up basis at death and for the forced recognition of gains for lifetime transfers. So no more carryover. The way this works right now is you can see right there, a client buys the stock for $10, holds it for greater than a year, gives it to a child sells it for 110. They've got a long-term capital gain of
$100, of course.
Yeah.
And because the basis of the donor, the parent,
was 100
carries over to the child.
Uh-huh. So, and also at death transfers, and this is one of the things that individuals do when they buy something. I mean, we've got people with, I've got clients with Apple stock that they bought it early on and they've been holding it because now they can't afford to get rid of it because they're going to pay a ton in capital gains. So they're kind of waiting to try and have a child inherit that, because the way it works now is if you own that stock and whatever your basis was, you pass away and leave it to a beneficiary, that heir now gets a stepped up basis.
So if I had bought stock, as in our example, for $10 a share, and when I died, it was worth $110 a share, and then it passed to my son, and he turned around and sold it, he wouldn't deduct the $10 I paid for it, he would deduct the fair market value at death. In other words, he would get a fresh start in the tax basis. That's to go out the window, and I think there's a high likelihood that this is going to pass. You're reading more and more about it and hearing more.
I think so too. So let's see how this works. So the way the proposed plan is going to work, if it's passed, the giver or the donor has to pay the tax on the gain at his or her next return. So for example, you buy stock at $10 a share, you hold it for a year, you gift it to the child when the stock is worth 110, child doesn't sell it, you're going to still pay that tax on that gain at the transfer for the year of the transfer.
Even though the child does not sell the stock.
That's correct.
It's the mere receipt of the appreciated property transfer.
And it's that forced recognition. So let's see how this would work if you're actually gifting stuff to a non-grantor or accountable trust. Talk a little bit about a separate trust. That's right. That's right. So here, when I gift my asset to the trust, Nils, that's a taxable transfer.
That's a taxable transfer. A lot of times we'll have clients set up irrevocable trust for children, and maybe they're 36 and have a alcohol or drug problem. You can't give the child assets, or they'll do something bad with it. Maybe they're minors. So you create an irrevocable trust, and then you transfer assets into the trust. Well, now if this goes into effect, the mere transfer of the appreciated stock, the stock I paid $10 for that's worth 110, when I put it into the trust, that's going to trigger a tax of $100, income tax.
Once you transfer it to the trust.
And if I ever want to say it was company stock, if I ever want to, when the child gets to be 30, I want the stock to pass out of the trust and go to the child. He's going to run the company. That's a second transfer, and that would also trigger the tax.
That's right. And of course, if you sold it in the trust, you'd also pay that. Right. So certain, when we say non-grantor trust, sorry, I was still on that last one there. There are certain trusts that are an exception, but it's basically going to say that all of the assets have to be included in your estate at death. So this is your typical estate planning trust. But all of your legacy trusts, your wholly discretionary trust to protect assets from Medicaid, all of those kinds of planning trusts, you're now going to have two taxable transfers, in and then out.
So let's talk about how recognition would take place at death. Look at this example. Client buys stock, $10. He holds it for a year, and then he dies and he leaves the stock to the child. The child does not sell the stock, but a tax would have to be paid on the appreciation or at death.
That's right.
In other words, they view death as another transfer, which it is, and there's no step up in basis either.
Yeah, no, that's right. So I mean, you get the higher basis, but you pay the tax on that.
You get the basis because you paid
the tax. That's right. So we're recognizing that gain, and that's where that works. And that's the same thing with trusts as well. If I have that grantor trust and I pass away, now my trust becomes irrevocable. When it goes to my child, all of that gain is recognized. There are some exceptions here to the forced recognition. You got $1 million for singles, $2 million for couples in terms of the gain. And of course, your 250 for your residence is excluded. That's
Let's
500.
talk about that last one.
Mhm.
So the rule there, a lot of people are unaware of this. It's not so important for us here in the heartland, but if you live on the coast, this is an important rule, existing rule. If I make a $250,000 gain on my residence in which I've lived 2 of the last 5 years, you can do certain maneuvers if you have a guest house, but
Sure.
you establish residency 2 of the last 5 years and you sell it, it's not taxable. If you're married, times 2, 500,000, not taxable. Final exception is gifts to charity. So under all the proposals that we are aware of, you're going to be able to give appreciated stock to the charity. They're not going to consider that's a transfer and you have to pay the tax and then give the net amount to the charity. You're going to be able to give the stock and deduct the full amount of the fair market value of the stock when you make the gift.
And this is really going to help. I think people are going to really have to look at that if they're charitably inclined, because it'll make a difference. And I think that, although we don't have all of the regulations done, but although some of them are being written, so I think that there is a real likelihood that a lot of this is going to pass.
Now,
There's but I think you can go to charitable trusts as well.
Fortunately, we do have some exemptions for family businesses and family farms, of course.
And this is at death, though. This is not a lifetime transfer.
Right.
This is at death under the American Families Plan. That's right. If it is owned and operated by the family and continues.
That's the key. It must continue to be operated by the family.
For so long as it continues, then you've got an extension.
Right. If there are any accountants out there, there's a current code section that does this called 6166.
And then the 15-year installment plan for the death transfers here. Once again, you can't do this with liquid assets.
Right.
You got liquid assets, you've got to pay, and the IRS can require some security to make sure that you're going to pay this tax over the 15-year installment plan that's under the American Families Plan.
Now, we don't know in any of the proposals whether this is going to come into effect, but I would say if any of these onerous tax bills do come into effect, there is already something that is similar to this in the code. So this is a pretty good bet that we'll get some relief here.
That's right. So we also, talking about forcing gain, you're really going to have a limitation on the 1031 exchanges. So right now you can invest in a property without tax recognition on the gain. If you use that qualified intermediary to make that exchange, you choose a new property within 45 days and you purchase it within 180.
In other words, you have a big gain on a real estate investment, maybe it's an apartment complex, and you turn around and you identify you actually identify a qualified intermediary. There are companies that perform this function. And then you have 180 days to identify a new property and to get your deal done. And they don't run at the same time. In other words, it's not 45 days plus 180.
That's
it's
right.
It's 180 for the whole process. But the proposed law does away with it, doesn't it?
That's right. See, it used to be you really were just deferring all those gains. And if we're forcing recognition of gains, proposed law says that you are limited to deferring only 500,000 for an individual, $1 million deferral for a married couple, and all the excess amount of your gain has to be recognized that year of the exchange.
Right.
So you're going to really limit that. That's proposed to be effective next year.
And that's worth noting because there's plenty of people in our community here that have these properties that they've invested for years and just rolled things over. And it's pretty clear in all the proposals I've read that we do have until the end of the year to think about this.
That's right. So let's just talk generally about the gift and estate tax proposals. Some of these were proposed on the campaign trail, others were Obama revenue proposals, and some are in current pending legislation. So this is not, this is certainly out there. So the current law, your tax-free amount for the estate tax is $11.7 million. Couples got 23.4 to use.
Well, I certainly have some clients, but I don't have a lot of clients
No.
who currently have to worry about the federal gift of the state.
And I think a lot of people really haven't worried about it very much. And that's right. The gift tax is also, it's a unified tax and it's between the two of them. So for most people, they have not worried about this for years because they haven't had to.
And there's also an interesting mechanism that was instituted in the last 6 or 8 years called portability, whereby if the husband dies and he's worth $5 million, he had 11.7. So the unused portion, the 6.7 million, could be used by his wife. She would get her 11.7 plus the unused portion of his, and that's been very useful.
That's true. It kind of did away with a lot of the AB trusts that we used to do before to preserve everybody's tax-free amount.
Right.
And now you could move the tax-free amount to some.
It really made estate planning in the last 8 or 10 years much
very easy.
Easier and less complicated. Now, those of us who are of a certain age, and I'm not putting you in that category, but all the old estate planning tricks that we had to learn back in the 80s and before are coming back and have to be reconsidered.
Well, one of the ones that was really useful is the valuation discounting.
Oh, absolutely.
So yeah, the current discounting, how did that work? How does that work now, Nils?
You're taxed on the value of what you transfer. We have a unified gift and estate tax transfer system. When you give property away or when you die and pass it on that way, there's an estate tax at the federal level. The Ohio estate tax was repealed by Kasich a few years ago.
2013.
That's good. We don't have to worry about that anymore. It's on the books in many other states, however, not Ohio. Everybody was moving to Florida.
So this discounting allows me to keep larger amounts smaller so that when I'm looking at my 11.5 million dollars that I'm allowed to give away, I can take something worth more.
But let's use an example of how discounting might work. So if we have $1 million business, you and I are partners, and I own 60% and you own 40%.
Typical.
Well, yeah. One would think that your share, 40% of the million, would be worth 400,000.
Sure.
In fact, it is not. And my share is not worth 600. It is worth more. Why? Because I'm in control. I can vote myself a big salary. I can vote myself a Mercedes instead of a Chevette as a company car. And I can not make distributions to you very often as a dividend recipient. So the courts have recognized for many decades that when you give away an interest, and it is a minority interest, that you can value it in a way the market would value it, the fair market value. And there are discounts that are accorded to minority interest. Karen's 400,000, so supposed $400,000 share may only be worth 300,000. My $600,000 share may be worth $700,000 or 750,000.
That's right.
The other thing is that if I have a business in Canfield, Ohio, and I want to sell it, there's only a certain number of buyers that are out there. It's not like I'm in New York City and there's thousands of them. So that is called a lack of marketability discount. And when you combine these discounts, it's not combined. The discounts usually run between 25 and 40%. Depends upon the nature of the business. Well, that's a discounting evaluation against which the estate tax is calculated. And there was enormous savings that was often available by correctly using gifts to make discounted gifts to children or other heirs. So the current law also allows us to do something that are called grantor retained annuity trusts and grantor trusts. And we'll just pause for a second and talk about those in just an instant here. Currently, there are also split interest trusts that can be that are useful when you're talking about charities. These are called charitable remainder trust and charitable lead trust, and again we'll get to them in a second. But the difficulty, Karen, is that the current law sunsets in 2026.
That's right. That's right. It goes back to the $5 million. Of course, it's adjusted for inflation. So at the time, it's going to be at the 6 million. And so one of the things that you need to do before this changes is you've got to use that.
In other words, we have 11.7 now that we can gift away before we pay that 40% tax.
Exactly.
But it's dropping down because when they passed the law, they didn't have 60 votes in the Senate, and so they cut a deal and they said, well, okay, after 10 years, it's going to sunset, and that's what we're facing.
And I think that that's one of the things that you really have to look for this. And I think that there are a number of opportunities, especially the minority discounting. But we also, so when we look at that, at the law sunsetting in 2026, I think that we may not need to wait till 2026 to see some of this, because we have some legislation right now that's pending in Congress. And we've got a House bill, and then we've got the Sensible Taxation and Equity Promotion Act of 2021.
What a moniker.
Yes, indeed, the STEP Act. The main features of these bills are going to repeal the carryover basis. We talked about that already with the Biden plan. And so we're basically going to say we're going to force that recognition and we're going to pay that tax. And we're going to periodically recognize the gains that we have in trust. So if you set up a trust for a child, it holds, it pays out after a certain period of years. And we'll talk about that in a minute because every proposal has a different years. You're going to have to mention that. Now, we talked a little bit about grantor trusts. The exempt grantor trusts are, once again, it's includable in my gross estate. If it's my trust, that means that I'm going to pay the tax then.
Let's talk about that a little bit, because this is not something the average person would be familiar with. If I set up a trust, and it's an irrevocable trust, permanent trust, and I retain certain control over operation of the trust, I retain the right maybe to substitute assets in the trust or to change the trustee of the trust. The IRS has one set of rules. It has its own separate tax universe, and it considers that I have not given the property away by putting it in the trust, and therefore I have to continue to pay the income tax. Let's say we're talking about an apartment complex. I put the apartment complex in the trust, and here come the rents. But I have to continue to pay the tax on that rental income. Now, let's think about it. That's a good thing, because there's a second set of rules that apply for gift and estate tax. And this makes no sense at all. It's just the way it is. The second set of rules says that if you take your property and you put it in the irrevocable trust, it's out of, and you write the trust appropriately, it's out of your estate for transfer tax purposes. So I take an apartment complex, and maybe we're talking about one in California or DC or the coasts, where it's not our experience here,
but the value goes away.
The value goes up oftentimes very rapidly. The appreciation of the apartment complex, or if this were all of or a portion of a family business, would take place not in me, the grantor who gave it away, but would take place in the trust. Beneficiaries of which would be my children when they're of the appropriate age. So that's a grantor trust, very often used as a basic estate planning tool. That these are under attack now under the various Democratic proposals.
That's right. So, I mean, you're basically going to force that recognition of gain as opposed to having it grow with someone else and having a lesser amount included in your estate, taxable estate. There are exemptions. So these are the exceptions in the estate, in the STEP Act. So you've got $100,000 for lifetime gifts. We're no longer, this does not propose that there is a unification now between your lifetime gifts and your gifts at death.
Now, currently, what's the situation?
So currently, 11.7, you can give part of it during your lifetime, and you can give part at your passing.
So if I gave away $5 million during lifetime now, when I die,
you still have 6.7 left, if that's the new math. But yes, so that's exactly how that would work. Now it's not going to be proposed to do that. Now you've got so much for lifetime gifts, and then you've got the $1 million transfer at death. Now the proposal, this is the legislation, the STEP Act. the American Families Plan, the Biden proposal, actually wants to decrease that $1 million at death by the 100,000 that you might have used during your lifetime. So you only get an additional 900,000.
I don't mean to interrupt you, but
ahead.
one of the other things that we kind of glossed over earlier, you still are going to be able to make unlimited transfers to a spouse, aren't you?
Yes, you can. Yes, you can. And you can also transfer to a qualifying spousal trust. And once again, somebody's got to pay the tax. It's just a deferral of that gain, but they won't recognize the gain if you move it to that qualifying spousal trust. And of course, transfers to charity, qualified disability trusts, but they're proposing that you will not get a step up if the gain's not recognized. Right. So if it's exempt under what you can pass, then you can. And one of the things that they will be tracking here, and this is a little bit off topic, but we saw recently that they're planning on hiring 84,000 new IRS agents. They are going to check so that when I say that here is what I got gain wise, they're going to make sure that if I gave that to Nils, that on Nils's tax return and my tax return, we are both using the exact same dollars.
There are problems with this stuff in knowing what your basis was, and it's going to be hard to bookkeep. All I can say is that now we're going to get artificial intelligence and supercomputers, and Big Brother's really going to be breathing down your neck.
Big Brother's going to have to check, because otherwise there's no way that they're going to be able to look at this.
Now, what about the situation we talked about, trusts?
So here, if I have an ongoing trust, so you talked earlier about the trust where it's taxable on the way in. So what if my trust is already set up and I've got a legacy trust, maybe an asset protection trust, a trust for my children, whatever it is, the House bill says that we're going to tax that. Whatever's in the trust, we are going to tax the gain. We're going to force a recognition.
Whether there's a transfer or not.
Exactly. Whether it's distributed or not, we don't want it held in trust without somebody paying the tax. Senate bill says we want to pay it every 21 years. The Biden plan says every 90 years, but they want to go back to 1940. That means they're going to start in 2030.
90 years after
90 years after it began. That's right. For the first year of recognition for those old trusts. So
if you've got an asset and it's sitting in a trust that Uncle Henry set up for you.
That'd be Henry Ford.
in 1940, and maybe you bought, I don't know, IBM stock or something that's just gone up and up and up. They want to bite, don't they? And
they do.
2030 comes around and they're going to force you to recognize it. Now, it's not we've talked in terms of a transfer tax, but it's really an income tax.
That's right. This is an income tax.
It's just recognition.
That's right.
Income tax.
It's that capital gains tax. But remember, when I'm recognizing those capital gains, if you've been holding it for a long time and you've got a lot of money, it's going to put you up at that ordinary income tax rate.
If
Absolutely.
That portion of the bill goes.
That's correct. That's correct. So we're also have some plans to change the tax rates. The estate tax rate. So right now we've got 11.7 tax free. We already talked about that. So the Sanders, Senator Sanders.
Not to interrupt you again, but the 11.7 was interesting to me that in the Biden proposal, everybody thought that he was going to lower that to $3 million, and they didn't. I don't know why.
Well, he mentioned it in the campaign plans and some of the other things, and I feel like he probably didn't need to, because Senator Sanders here has already introduced this in his 99.5% Act, or it's for the 99.5%. And basically,
he had last year, he put something up which was for the 98.5.
Yeah, 99.8%. That's right. And now it's the 99.5%. That's right. So these bills have actually been out there, and he just kind of renewed it here. And this is going to increase the tax rates up to as much as 65% on very large estates.
Right. If you're over $1 billion, if you're a billionaire.
That's right. That's right. But if you have $3.5 million, your rate goes from 40% to 45%.
And I think all of the bills are talking about that type of at least a 5% increase over the current 40%.
But look at that. So right now we're at 11.5 million, 40%. Here, if I go to 10 million, I'm going to pay 50%. So I mean, we're getting at least 10% there.
And we don't have a estate tax in Ohio. But how would you like to live in New York or California? These tax rates are going to be up, through the roof. I mean, just there's 12% rates in New York, and it's really something.
Exactly. And of course, so once again, the Sanders plan disallows that stepped up basis.
No more step up.
No more step up and for certain grantor trusts. And once again, the ones that are exempt are the ones where the property is included in the person who set up the trust in their estate.
And no more valuation discounts.
No more valuation discounts. Actually, for non-actively traded interests and business assets, other than working capital, there's going to be no discount for lack of control or lack of marketability if the transferee and the family have control or own a majority interest in an entity. And that's generally where those valuation discounts got. You and I talk about us owning a business, but I think some of these things where you've got family members, that's where they have used it a lot to transfer assets within the family.
Right.
And now, absolutely, those are not going to be allowed. And also the defective grantor trusts, and Nils mentioned those a little bit, and we'll talk more about those later.
Let me just clarify again, because that's a lawyer term. You don't want to use too much lawyer talk here. But you remember my earlier comment about setting up a trust, transferring property in the trust, the apartment complex, and then having the person who transferred the money in, the property in, pay the income tax on the apartment complex, with the children being the ultimate beneficiary someday. That's called a defective grantor trust.
That's right. So Senator Sanders not only wants you to pay more at your estate tax, but he also wants you to stop giving that money away. Let's check that next slide. He wants to limit the annual exclusion amount. So the annual exclusion amount is the dollar amount excluded from the gift tax amount that you can give away. Remember, we talked about that $100,000. They're thinking of limiting it to $100,000 that you can give away during your lifetime before you pay the tax, the gift tax. Right now, you can give away $15,000 per person per year.
But that, of course, is on top of the 11.7. So
that's right. The 11.7 is taxable.
If I had 10 people in this room, and let's say the year before I gave my children $11.7 million, okay, I've used up my lifetime, or we talked that you have 11.7 to use at lifetime or at death or some combination of it. Once I've used that up, if I have 10 people in this room, under the current law, I can give them, can I not, $15,000 in 2021, 2022, and right on down the line.
Absolutely. And in fact, your wife, if she's so inclined, can give them another $15,000.
Right.
So you can do that. And it doesn't matter. There was no cap on that. As long as you didn't go over $15,000 per person per year. So Senator Sanders wants to limit that now to $10,000 per person and $20,000 per donor. So you can only give a maximum of $20,000. So however you spread that out, right, exactly. That's right. However you spread that out is fine, but you need to have at least 2 people.
I can't do 15 and 5.
No, you can't.
10, where I could give
that's
20
right.
people $1,000.
Sure, you can do that. So that's really going to be that's going to be a huge impact, especially for people who have used life insurance and life insurance trusts. That it's very common to purchase life insurance to say, I need this liquidity to pay the estate tax.
Right. Maybe I could talk about that. What happens is we can use this. It's called the annual exclusion deduction. Currently $15,000. We can write a trust currently that uses that such that money can be put into the trust and sheltered by the annual exclusion. I won't get into the details. It is a little complicated, but it's commonly done. And then without reducing the lifetime exemption, the 11.7, life insurance can be paid. And every year the settlor, the person setting up the trust, would gift money into the life insurance trust, which would be tax-free for gift tax purposes. And this has been a staple of the life insurance business for 50 or 60 years.
Absolutely. We haven't worried about it too much in the past years because we've had 11.7 million, but now it's going to be more important to do it. But it's going to be an issue for people with large life insurance policies with big premiums. I've got a client where the premium's over $20,000 a year. So now this is going to limit how much he can contribute every year to pay that premium on his policy. And so it's really going to impact that quite a bit. Maybe you get, I'm not sure, but life insurance does play a huge role in this.
You have to get out the spreadsheet and you have to model these things and you have to work on it with your accountant and see, maybe you want to get, they're called irrevocable life insurance trusts. Maybe you need to get some in place this tax year before some of these changes go into effect.
So the grants.
Oh, yes.
Can you talk a little bit about the grants?
Yes.
So what is a grant?
A grant is called a grantor retained annuity trust. And it's a little complicated, but I think our audience can quickly get the concept. If you set up I think I have a...
We've got a slide on it later, so we'll talk a little bit how that's going to work.
Touch on it now, but it's a way to make a transfer into an irrevocable trust. And it's kind of a heads I win, tails I don't lose situation. And the rules says that if you take money or appreciated property or appreciating property and you put it in a trust and you retain the right to a fixed payment from the trust for a term of years, if you survive the term of years, then whatever's left in the trust can go to children. And these arrangements can be used as another type of a so-called estate freeze. We talked about one earlier with a grantor trust where I put the apartment complex in and so forth. This is a way to sort of freeze the valuation of your company, and so that the increase in valuation will go on to children. That is under attack.
Well, and because you had to survive the annuity trust length of time, we used to do a series of rolling grants. You do one for 2 years. Next year, I do another 2-year one.
In other words, if you don't survive, it comes back into your estate and it's taxed.
That's right.
Okay.
So now there's going to be a 10-year minimum term. Right. So no more rolling grants. It's got to be at least 10 years, and they're going to limit how much you can put in and stuff like that. So let's just, with this forced recognition on gains and paying it at income tax rates.
It's well to work our way through some examples.
That's right, and the estate tax. Yeah, Nils, do you want to just show how that works? And we're assuming that $1 million limit on the estate tax exclusion.
Right.
And the tax at more than $1 million being taxed at ordinary income rates.
Let's say that these rules go into effect. And let's say that we have a $5 million asset. And let's also assume that we've used up elsewhere on our other assets, sheltering them. And at this, how would that incremental $5 million asset be taxed? Because we've got 2 taxes. Remember, it's easy to think we only have one. There are 2. We have the income tax and the forced recognition that triggers the income tax. And then we have the gift and estate tax. So let's assume that we have an asset that maybe it was Apple stock that for all intents and purposes, you bought it at the beginning of the company and it's worth $5 million now. And you have 0 basis, to make an easy example. Let's assume that instead of the 39.6 income tax rate that we're going to round it to 40%. And we know that the current inheritance tax rate is 40%. Let's assume that that's the same. So in this further example, let's assume that we die and that both of these taxes are triggered and we've used up all our other deductions. How would that work? If the income tax is not deductible against the estate tax, the result would be, with respect to this $5 million asset we're discussing right now, $2 million would have to be paid for income tax. An additional $2 million would have to be paid for the second tax, the estate tax. And out of the $5 million, the kids would get $1 million. Now let's make another assumption. We don't know which tax, if either, is going to be deductible against the other. It's just not clear. So assume that the income tax is deductible against the estate tax. And here you would pay an income tax of $2 million. The estate tax calculation would get a deduction. The estate tax would be $1.2 million and the children would get $1.8 million. Similarly, if the estate tax is deductible against the income tax, then the estate tax would be $2 million, the income tax $1.2 million, and the children would get the $1.8 million.
So let's talk a teeny bit about generation skipping transfer exempt trust, the dynasty trust.
I'm glad we're doing this over the new now. I hope people haven't eaten yet. This is the one that makes you nod off, but it's on the books.
Yeah. So, you know, a lot of times people set this up, they allocate their generation skipping transfer tax exemption to these trusts. And
let me give you an example. Let's say I'm a rich grandfather and I want to make a big gift to my grandchildren.
all right.
And I mean, a big gift, like tens of millions of dollars.
Mm-hmm.
Years ago, wealthy people would make a gift from a grandparent and not to their kids. They would skip that intervening generation. And the reason they did that was so that the generation of their children would not be taxed.
Well, otherwise you pay a tax here and a tax here.
You pay a
and
tax
you just
at every
avoid it.
generation.
That's right. Mm-hmm.
So if you make a generation skip from granddad to grandson,
Mm-hmm.
you can trigger, if enough money is involved, you can trigger a double tax. The government wants a bite in every generation.
Mm-hmm.
So it became the style for people to use the available tax credit, which is also for the GST tax, is the same as for the gift and estate tax, 11.7, to set up which were called dynasty trusts, to use the sheltered amount, the tax-free amount, put it in a trust that never fully paid out, and having been subjected to a GST tax, it was purged in any future tax,
Yeah.
and it would pass.
Keeps growing and growing and growing and
Right.
growing, and that's how you can do that money.
And that's under attack.
Well, Senator Sanders, his bill basically says, nope, after 50 years, you're done and you're back to paying the tax.
gotta pay the
So
tax.
you got to pay the tax. So what can people do now? We talked a teeny bit before about grants. How do those work? Can people do that now, Nils?
Yes, they can. So let's work through an example. Here's Warren Buffett. Let's say Warren takes a bag of money and he puts it in a irrevocable trust called a grantor retained annuity trust. He writes the trust so that he is paid $50,000 a year. Say it was a $5 million payment. And if he lives to the term of the trust, he's got to survive the trust or it all comes back in his estate. If he lives until the end, then when he through the 10 years, when he passes on, I just literally had a client to survive a trust term and it goes to the kids. Okay, so that's all the appreciation in the trust would pass to the kids. So now there we go. The reason these work so well is that you have to use you have to use an assumed interest rate in modeling the trust. There we go. You have to use an assumed interest rate. Rates, because the government has artificially manipulated down interest rates to get the economy going. Rates are historically low, under 2%. So the practical effect of these things is the government will assume that your money paid into the trust is growing at 2%. Well, let me ask you, Karen, what happens if you put business interest in here and your business grows at 8% or 10%? All of the growth and the increase in that trust takes place in your children.
That's right.
Assuming that you survive the term.
That's right. You get the 2% back, but they get the 6% extra every year.
So I had a friend in college. His name was Leon Black. Leon Black owns Apollo, is a multi-billionaire. And he was advised by, just for grins, by Jeffrey Epstein, the famous.
This wasn't a close friend, was it?
No, it wasn't. He was in my dorm. What can I say? He was advised to use a series of these grants, these short-term grants, as the principal vehicle for his estate plan, to reduce estate plan.
Sure.
These are still effective. There's probably a very good chance that we can do these now. This is something that people of substance should think about using, because we're going to lose this. That seems very clear.
Well, and I think too that the sales to the intentionally defective trust, you talked about that earlier, a grantor trust where he retains certain rights but gives up others,
right,
is what we call a defective grantor trust.
Right. So here's Warren, puts the money in the irrevocable trust again, but he retains these rights over the trust to substitute assets, change the trustee. He's got to pay the income tax on it, and his kids will eventually get whatever's left at the end of the term.
Yeah.
So the effect there is, again, it's complete for estate and gift tax purposes, incomplete for income tax purposes.
Yeah, and we look at that as a freeze. Basically, when we say the word freeze, we're basically freezing the value
so that the increase
that's
takes
right.
place.
The increase goes somewhere else. So what could people do right now?
Well,
I mean, knowing that these things are coming down the pipe.
the first thing is you must know what you've got. What do you own? What's the business structure? Is your paperwork in place? Okay.
And what is it worth?
And what is it worth?
Mm-hmm.
And you have to decide that the value is not a discounted value, as we were able to work with, not today, but not next year probably. What you got to model this. You got to say, well, okay, if I die in 2022 or 2023, and I'm going to get hit with a transfer tax, an income tax, because of the recognition of an appreciated asset, and I'm going to get hit with a estate tax.
Mm-hmm.
What does that do to my company? Do I have the liquidity to pay the tax? Now, if you have a family business, you may be able to spread out the payment over a number of years.
Sure.
Okay.
But if you don't,
how are you going to pay that?
if it's all my Apple stock, I'm going to have to sell
The
it.
estate tax is going to be due within 9 months.
That's right.
So you need to think about having adequate liquidity, which suggests life insurance trust, and so forth.
Yeah, the life insurance trust, basically by putting it in the trust, you take that life insurance out of your estate taxable amount.
You don't want to die owning in your individual name life insurance because it's taxable. People don't understand.
Yeah, not income taxable, but it is it's added to the estate tax. That's right.
So you don't want to do that.
Yeah.
You want to take your income tax deductions next year, your big deductions. You may want to harvest certain gains this year, so you're in a lower tax bracket.
Mm-hmm.
For mega estates, again, you may want to have the to harvest, so to speak, gift taxes at a 40%. Well, let's see, how do you harvest the tax at 40%? But if it's going to go to 6 for the mega wealthy,
yeah, if it's going to go to 65% next year, I want to give it away now and go ahead and pay the 40%. I don't want to wait and end up having to pay the 60%, 65%, especially since more of it will be taxable. Right now, I have a bigger deduction.
I think that this year you're going to want to, certain people with the right assets are going to want to think about doing grant or retained annuity trust.
Sure.
And rather than, they're probably going to want to do a series rather than risk having to survive for a 10-year period. That's on your age.
Sure.
You got to do the math again. Look at the actuarial tables. But you may want to have 1 for 3, 1 for 7, 1 for 10, or something like that. So it's likely you're going to survive for at least several.
Well, the other thing too is high income earners who are close to retirement may want to not put money into a tax deferred income.
In other words, shelter
it right now into my 401k, whatever my tax deferred retirement plan is, because I'm saving money that I would otherwise pay a lower tax rate, and I'm going to pull it out later and pay a higher tax rate. Yeah, I mean, so you just really have to watch that once again, and don't forget the Secure Act. When you're saving all of that, your kids are now going to pay that income over 10 years on whatever you have saved tax deferred, and by doing that, they're also going to hit that higher income tax bracket. So you're going to lose so much more of what you're saving, but you do need to be careful about that. So I think we also need to look at the gifts of minority interest. If we could do that this year.
You want to get those.
That could help.
This is really important. If you've got a business and maybe your kids are too young to receive a share of the company, create an irrevocable trust and do your gift into the trust for the benefit of the children who can receive it when they get older. But you want to be able to gift away minority interest this year. Before we lose the ability to possibly lose the ability to do that next year. One other thought I had when I was looking at this material last night, it would seem to me that if you're getting up there in years and you're a person of means, particularly if you have a business, and all of a sudden you get some bad news, that maybe you're terminally ill, or just the actuarial tables are catching up with you, you may want to sell your interest to a trust, to an irrevocable trust. Why would you do that? to trigger the recognition of the appreciation in that particular asset. In other words, if you die owning the appreciated asset, if these rules go into effect, you're going to get nailed in one tax year for all of that gain. We already talked about installment sales. An installment sale,
Next slide.
The installment sale is oops, there we go.
Yeah.
The installment sale allows you to pay the tax when you receive the money. So if you have a 3 or 4 year deal, so somebody who's older and gets that bad health news, you're going to seriously want, and these rules go into effect. We don't know that, but a lot of this stuff is going to go into effect because they've got the votes. You're going to want to consider an installment sale to smooth out that. Let's talk about.
Well, these are some things that you can do after this is enacted as
Right.
well, and just that smoothing. So by smoothing, you're basically saying don't have a huge gain or huge income in 1 year.
Right.
Spread it out, right?
Exactly. So there is a concept of smoothing. You're going to hear more of if this recognition of appreciated property, other than its sale or death, does take place, you're going to want to look at your growing assets, and from time to time probably figure out a way to trigger the recognition. Might be a sale to a child or another family member to an irrevocable trust.
Well,
you're going to
yeah,
want to recognize building gains more frequently.
Well, and if we're holding assets in trust for children, because we still want to do some of that basic planning of not giving everything to our children so that they don't go out and become productive members of society. We're still saying that in our household. So we still want to be able to do that, but we can transfer into a trust and have it sold between trusts with similar things. So you're recognizing the gain. I don't have to wait for 21 years or whatever it's going to be where the gain has really built up, or have to pay it upon distribution. You can go ahead and that will make it smaller. It keeps it underneath that threshold so that I'm not paying as much in income tax.
Now, I see we're running up
avoiding some of the
against
gift
our hour.
We are
I
indeed.
don't know whether Ryan, there are questions in the queue out there. Certainly you can call us after the show is over and we'll be
Sure.
happy to talk with you. But I would just close by saying that you don't want to be passive. I think it's a mistake to sit and say, well, we don't know what's going to happen. Maybe nothing will happen. And I think it's a further mistake to say, well, the Republicans are going to come back in 5 or 10 years. You don't know these things.
You don't know, and you don't know what's going to be able to be changed. And so, start talking to all your advisors, your accountants, your financial advisors, your life insurance advisors, your other wealth advisors, your attorneys. It's time to really look to see how could these impact you, and is there anything you can do now, and what can you do later as well, just to make sure that you're going to minimize the negative. So sorry, Ryan, we kept talking after asking you a few questions.
No, you're good. There was a couple questions in here, although they provided a phone number. I think they want to give you a call. So I'll forward
Okay.
it. But just want to really thank you guys because it was a very informative discussion. I liked how you put up examples and how it was applicable. I think that really explains to people just how much, it's hard to, understand or comprehend the impact it could have until you actually see dollar amounts in front of you.
Exactly.
Scenarios. So just a really great job today, especially towards the end, all those actions you could take now. And if anyone who was attending or was not able to make today's presentation, this will be available for full replay on businessjournaldaily.com in about a day or two. And you'll be able to go in and check out any key points you missed. So just want to thank you guys very much. And if there's anything you'd like to add in closing, please go ahead.
Well, I just really want to thank you all for participating, and hopefully we'll be hearing a lot more about this soon, but start now, I think.
Yeah, I think the handwriting is on the wall and there's some bad stuff coming down the line.
Yeah.
Unfortunately, it's got to move through the sausage making facility
Process.
that is the Congress, but somebody said there are consequences to elections. And
That's right.
There's going to be some consequences.
And some of this is really going to get through. Maybe not all of it, but some of it will. So thank you again for participating here. Thank you, Ryan.
Oh, thank you guys. And everyone, thank you for being in attendance and have a wonderful afternoon.
Thanks for watching the video. Be sure to like, subscribe, and hit that little bell for notifications. And also make sure to connect with us on Twitter, Facebook, and LinkedIn. For all of your business news, visit businessjournaldaily.com. For all of your arts and entertainment news, go to afterhoursyoungstown.com.